Hey everybody, my name's Mimi Evans and I'm the owner-operator of Fearless Bookkeeping Services. Today, what I'd like to talk to you about is the big three financial statements that every business should know. It's kind of like your report card. I'll be honest. Your profit and loss, your balance sheet, your cash flow statement, I get it, they sound boring. However, they are very important. Your profit and loss, we all know that one. That is everybody's favorite report. Companies talk about record breaking profits or how they had a Q2 loss that might cripple the company. The profit and loss is the most common statement because honestly, it's the statement that most people care about because it tells you how much money you made. You've got your income, cost of goods, and expenses. That at the end tells you did you make money or lose money? That's everybody's favorite one. In your profit and loss, you've got the income, invoices, cash, receipt. All of that is, it's our favorite part. I love seeing that little email that says we got paid. Then you got cost of goods and expenses. Cost of goods are a very important metric that a lot of companies will argue is not necessary. Here's why they argue it's not necessary. Well, the net profit's the same. Yes, you're right. Mathematically, I can't argue with you. But I can argue that it's not giving you the full picture of actually how profitable you are. Why? Cost of goods are directly related to the services you provide. So if you are a construction company, the lumber, the labor, the paint, all of that is a cost of good. If you're IT support, your guys, any kind of ticketing software, all of that is related to you providing that service to your customers. Are you e-commerce? Do you have all of your product on your expenses? No, you sold it. So that goes in the cost of goods. Here's why that's important. Income minus cost of goods is gross profit. That is what tells you if you actually have a viable business. Here's why. If 80% of your income is cost of goods sold, you have 20% left for expenses. Let me paint a picture that I think will help make this clearer. Lemonade stands. We all remember them from childhood. They're fantastic. Who doesn't love fresh lemonade on a hot summer day, especially in Georgia? Well, what's a cost of good for a lemonade stand? The lemons, the sugar, the water, the pitchers, the cups, all of that is required and necessary to provide someone with a cup of lemonade. But here's what is not necessary. You don't need a stand. You could sell that lemonade with or without a stand. You don't need a cash register. You'll get the cash with or without that register. So the difference is that these items are directly related to you offering your service or your product. And if 80% of your income is cost of goods sold and you only have 20% left, you probably have a break-even net profit, if not a negative. The average percentage for most businesses on expenses is anywhere from 20 to 25%. So if your cost of goods is anywhere above 70%, you're probably not making any money. But if all of your costs of goods and expenses are in expenses, you'll never know because you're just looking at your net profit. And so in your mind, you're going to cut expenses because that's the first thing every business owner will do. Well, we don't need this subscription and we don't need that subscription. But then you're still wondering why the net profit's not looking right because you're not looking at the right levers to pull to adjust your net profit. It's just a lever, but you've got to have it in the right place to really understand. The next thing is the balance sheet. The balance sheet is actually the most ignored report ever by non-accountants. Whenever I go into an assessment, the first thing that they show me is their P&L and how they don't understand where all the money went. When I ask them about their balance sheet, and they're like, oh, I never check that. Oh, I don't even worry about that. Oh, it doesn't matter. When ironically, if your balance sheet is off, if your balance sheet is wrong, there's no way your P&L is accurate. Your balance sheet is the health of your business. It's your assets, your liabilities, and your equity. Equity and assets are probably your favorite part. Equity is your piece of the share. It's your piece of the pie. Assets is anything that can be converted to cash. So bank accounts, office furniture, computers, hardware, all of that is an asset. Liabilities are what you owe people: vendor bills, credit cards, line of credit, loans. Equity is the value of your investment. As an example, that's in plain terms. I get it. But if you've put in the sweat equity, you have put in the time, you started your company from zero. That equity tells you that if you had to shut your doors today, are you paying in to close, or are you actually making money from this? This is why your balance sheet is more important than you realize. If your balance sheet is accurate, the rest will flow. But you have to take a look at that balance sheet. Which brings me to my next point. Profit don't equal cash. I know we like to say that even on a cash basis. We'll talk about that on another day, accrual versus cash. But even on a cash basis, that is not accurate as to what should be in your bank account. Why? Here's an example. Your balance sheet holds your credit cards. And that's the number one way that most business owners pay, next to ACH. So when you go out to dinner with your team and you pay for that meal and it goes under your profit and loss as a meal, the cash still hasn't gone out yet. It's sitting on your credit card to be paid. So while your net profit says, I don't know, $5, I hope not, but $5, that $5 is not really there because you've got to pay it on your credit card. So this is why it's important to understand your balance sheet. Your balance sheet will take to your profit and loss, and then it also goes to your cash flow statement because it lets you know how much money you're making from operating activities and financing activities. And we say financing activities because, do you have a CD account? Do you have a savings account? All of those are considered financing activities within a business. But if your balance sheet is wrong, the rest of it's not going to flow. So if you would like someone to take a look at your balance sheet, take a look at your reports, and make sure that everything is copacetic, let us know. Like, subscribe, follow us on Facebook, Instagram, and LinkedIn. Give us an email, give us a call. We would love to talk with you. Heck, if you want to come on and go onto the podcast, I'd love to sit down and have an interview with you and we can work it out live.